Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the community. My name's Bryce, and we have a massive episode today. As always, I am joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. For people who have been listening to the show or watching the show for a while, they may be familiar with Luke Larrative from Seneca Financial Solutions.
Definitely familiar.
Well, with everything going on in the markets, we wanted to get the real brains behind Seneca Financial Solutions in the studio with us. And so also from Seneca, co-portfolio manager of the Seneca Small Companies Fund. Today we're joined by Ben Richards. Ben, welcome.
Gentlemen, always a pleasure. Debut in the studio, so I'm stoked to be here and lots happening in markets.
Yeah.
So plenty to discuss.
Debut in the studio, but not debut on the show.
Not debut on the show. Viewers might recall that I was ringing the bell for an Ordinate
Yes,
short.
I was about to say that. I do remember that.
Clearly. How's that going?
Do you want to have a bit of a crow? Yeah.
Let's pull up the chart. But no, I think I was also on the buy or sell. So
Yes.
let's do the other one.
Yes. They love you over on that show, so thank you for doing that.
For people who aren't familiar with the Ordinate story, it had run very hard, was up, triple-digit percentages, but in the last year it's down 73%.
Still bullish?
No, still bearish.
It's like a lot of this stuff. It's come back to the point where maybe you start to have a look at it again, but not quite getting bullish yet.
Well, just a quick look. Google's got its current PE ratio at 140, so maybe not quite back there yet.
Maybe $1 or $2 lower at least.
Now, we should contextualise, it's currently the 10th of April, and I guess we want to say that because things are moving in markets so quickly at the moment that by the time this goes out, who knows what's happened. But that's where we want to start, I think, Ben, with the current state. We've seen a pretty significant sell-off over the previous sort of week or so, and then at the time of recording, NASDAQ up 12%, S&P 500 up 10%.
We're back.
So back. How are you just thinking about this moment?
Well, yeah, I think it was been the sharpest 3-day sell-off since COVID in my career that I can remember, given that I wasn't working in markets in the GFC, and I'm perhaps not as old and wise as Larry and some others in the industry. But I think it really tests your conviction, and probably for plenty of people in the community, they're wondering, do I double down? Do I just hold? Do I panic sell? There's lots of Peter Lynch, Warren Buffett quotes starting to do the rounds, buy when there's blood on the streets, all that kind of thing. But I think the biggest takeaway, and Luke and I have discussed it a lot over the last week, is you can't time the bottom. Like, it's impossible to know when the bottom is. No one rings a bell at the bottom. I even think, like, clients, probably the main mistake that we see clients make is they sell and they say, I'll get back in when it's stable or when it's the bottom's in, and then it never comes. The market can gap up 5-10% in a week pretty quickly, and they just never have a chance to kind of buy back in. And so the returns are just, below the market. So it's probably the biggest mistake we see, and probably the biggest element where I think you can probably help as an advisor or just someone that works in markets talking to people about it, is just to kind of stay the course and stick to their strategy. I know you guys talk a lot about kind of dollar cost averaging and ETFs and kind of different strategies that can weather the volatility. But seriously, this is when you can add a lot of value to your portfolio over the long run.
Were you, so I imagine you had some clients calling, panicking, and I guess your message based on what you've just said was, let's just stay the course. But were you actively...
No, he just quoted Warren Buffett back.
Yeah, true. Give Warren a call. Yeah. But were you actively deploying cash through this time, or how have you thought about that?
Yeah, well, we've been fortunate to get some inflows, particularly in the Small Companies Fund, which I'm pretty focused on day to day, at the end of March, so to be deployed the start of April. And again, you can't really time these sharp drawdowns. So you've got to kind of deploy as you see the opportunities come in. And if you're holding too much cash at the start of the month, if the market runs up and away from you, then you can kind of run into trouble there. So we've been deploying over the early days of the month, which means we didn't catch the bottom, but it does mean we're pretty much fully invested as of the last couple of days.
Now, for people who are wondering, don't you worry, we're going to ask Ben where he's been deploying the cash. But before then, I just want to hold on, I guess, like the current market and what you were talking about with clients. Because I guess one of the structural challenges you face as managing this small caps fund is if people really panic and clients start redeeming money, you've got to sell positions that you might really believe in to meet those redemptions. So, Bryce was asking you earlier how you're speaking to clients, but I guess give us more information on that. Like, how are you actually reassuring people and getting them not to panic? What are the quotes or the stats or the history that you're drawing on to help people remain calm?
Well, fortunately, I don't have to do a lot of that.
That's why Luke's not here. He's on the phone.
He's on the phone. He's sending emails.
Yeah. Luke would just be refusing as well. He'd be like, not doing it.
Boys, I'm laser focused at getting into the weeds and looking at the opportunities.
Nice. So that's what he's telling clients.
Yeah. Sorry, I don't have time for this.
But I think Luke's quite good at that, and he sent an email during the week, and he's been on the phone to clients. And fortunately, we're in the position where a lot of clients have been dealing with Luke for a while and have built up a trust based relationship. So if there is a bit of a slip in the market, people aren't just sort of panicking and they do kind of understand what they're investing in and have the conviction, which is kind of the central theme when it comes to staying the course, I think. But from my perspective, it's really just a question of how do we reposition people, if at all, and what's kind of the best bang for buck in this market. And it's interesting you mentioned small caps in terms of redemptions. Fortunately, we've had not a redemption today. 33% return over the last 12 months. I should hope there's no redemptions, boys.
Yeah, what more do we need to do?
Yeah, honestly. But you're right in the sense of if there's a sharp drawdown, what really excites me is that small caps can be hit quite hard on low volumes, but if the market rips, small caps are the best place to be. So I think that's a bit of a theme. Yeah, definitely some opportunities emerging, we believe.
So that's, I guess, a look at how you guys are thinking about the portfolio and, managing clients. How do you think about what we're seeing? How will it impact, I guess, Australia? Any sectors you're avoiding? Any sectors you're particularly interested in? Like, before we get to the bottom up stock picks, how are you just thinking top down? How this is going to change the world? Yeah,
well, we're talking just before the show, and Ren, you're the macro guru, so interesting to hear your perspective.
I'll take your word on that.
But it's a tough one because the goalposts are changing every day is probably the first comment to make. If there's tariffs everywhere, then you'll probably see slowdown in global growth, which is kind of primarily, I believe, the market's been selling off so sharply. The overnight move indicates that maybe we're seeing some of those peeled back, and it's mainly just kind of the US-China quite heavy tariffs left in place. So, yeah, it kind of remains to be seen. I would say that in terms of past drawdowns, like if we look at COVID, March 2020, what happened in markets then is a bit of an analog. It's different now in the sense that there's kind of less firepower to do anything about it. Like you can't sort of pump stimulus into the current economy. You can't really cut rates if tariffs are going to be inflationary in some areas. So when you look at kind of the GFC and COVID, where the central banks had a lot of bailout or rates movement capacity, there's kind of less room to move. I think that's another reason why people are being so spooked. The ultimate negative combination is if we see a slowdown in global growth and inflation's moving the wrong way, basically, yeah, then it's kind of like, what's the best asset class to invest in? So I think that's kind of what people have been alarmed about.
Yeah, well, the answer to your question there, if you get into like a stagflation situation or worse, people would say like gold, fly to safety. But gold's down as well.
It is, but in Aussie dollar terms,
okay.
Important for small cap producers. But that's another thing we've seen. We've seen the Aussie dollar sell off as well. So obviously, if you're selling a commodity in US dollar terms, but your costs are in Aussie dollars, then you're actually more profitable than you were before. So, but yeah, you're right. Gold has been one kind of safe haven, and it's all well and good for me to talk about a bunch of opportunities that are buys, but if you're fully invested, well, it's kind of irrelevant. It's like, what are you going to sell or rotate from? And gold is probably one area where it could be used as a funding source, just given how strong it's been.
And like, let's be clear, people who had gold in their portfolio aren't too upset about the last week because they've had a really good year. But yeah, it's an interesting one. I guess you kind of alluded to mining there, and you guys have had a lot of success with the Australian mining sector. You've picked a couple of M&A deals and have picked some good stocks. Obviously, the mining story is, well, for a number of minerals, the mining story is tied to the China story. So how are you thinking about, the tit-for-tat escalation of tariffs between the US and China, and if that will have any boil-over effects for your mining stocks?
Yeah, I think the mining sector's been hit probably one of the hardest out of all the sectors over the last few days. Obviously, you've got things like iron ore, copper, anything in the steelmaking complex, coal. Even oil's been hit pretty hard just on the global growth slowdown fears. So that's probably one point to make. But also we're seeing the equity valuations kind of diverge from the commodity in a sense. So you mentioned iron ore and how critical it is to the, returns in the Australian market. But the iron ore price is still, it's only just under $100 a tonne. So until 2 days ago, it was above 100. I think it's now 94, 95 as I checked last night. That's a really strong price still. Yeah, tariffs might sort of, if China's the largest producer of steel and Australia's the largest supplier of iron ore, the raw kind of ingredient for steel to China, and obviously we're seeing the US and China kind of go tit for tat and it's over 100% tariffs, that will impact things. However, you're seeing BHP trading below $35 now. So that's kind of pricing in a bit of downside. They're still making great cash at the current iron ore price. And I think an underappreciated thing about iron ore is that analysts have been bearish for years. There's new supply coming on from Africa and Simandou, even, the MinRes Onslow project. Like there's plenty of supply out there, but iron ore has always been a demand-driven thesis. So there's been a bit of a floor price at about, I would say $90 US a tonne, because China, on an equivalent basis, can produce some iron ore at about $90 a tonne. So that's when it becomes kind of break even, because the grades are lower and it's higher cost than the guys out of the Pilbara in Australia. So if you kind of make that a like-for-like basis, that's kind of typically been a floor in the market. If the iron ore price holds at $90 a tonne, then BHP Rio, who are producing for $20, $25 a tonne, like it's not that much of an inconvenience for them, really. Mm-hmm. So yeah, I think it's just two different questions. It's what are commodities going to do and what are the equities going to do, especially given that there's a lot of bad news in the market. And this is another thing that I've been banging on about for the last couple of days. But what's the incremental news going to be? Is it going to be incrementally negative or incrementally positive? And when there's lots of fear and there's tariffs on everyone, I was thinking it's surely going to be incrementally positive news, which could see markets move higher. And I mentioned small caps as a key beneficiary, but we also think resources is another one that, copper's gone from over $5 a pound to the low fours, which we think is probably reaching a bit of cost curve support there. And that's another one that, could be up 50 or 100% in a bull market. So
what's your best copper play?
AIC Mines out of Queensland.
Okay. Why do you like it?
We're actually... we've been speaking to Aaron Collar in the MD recently. He's ex-Evolution, which, did a bunch of M&A deals and basically went from a few $100 million market cap to a several billion market cap. And he was kind of the corporate development guy that did a lot of that M&A. So first of all, he's generated shareholders a boatload of money, but his new play is his copper play in Queensland, near Mount Isa, tier 1 jurisdiction. It's 40% cheaper than your Sandfire, Capstone, Mac Copper, the other three larger copper players that all your other fund managers in here will be waxing lyrical about.
Yeah, okay.
But AIC Mines at 200 million market cap is under the radar. It's undervalued, 40% cheaper, but for 3x the production growth. So they've got an existing deep producing mine, which is profitable, but it is quite deep. And then they've got they made an acquisition, which is this shallow nearby ore body called Jericho, which is kind of going to increase production from 12,500 tonnes per annum to 20,000 tonnes per annum. So we think if you're invested in a commodity player, which is strong balance sheet, growing production and undervalued, it's got great leverage to any recovery. And even if you don't get as much recovery, you limit your downside. One quick point on balance sheet is I think in these sharp drawdowns, like we can have conviction to hold something like an AIC Mines knowing that it'll come out the other side. It's still got growth. It's still got plenty of cash. and it still makes money at current prices. Where you can really get into trouble, mineral resources, lots of debt, and it's been really whipsawing around recently. But the worst thing you can do in these scenarios is be forced into raising equity at low prices. Like during COVID, in April 2020, Flight Centre and Webjet, a couple of travel companies, were obviously highly exposed to the COVID lockdowns, both had to raise equity and diluted their share count by 59% and 49% respectively. So it remains to be seen whether someone like a MinRes will need a raise, but if they do, and say they raise a couple $1 billion, they'll be diluting their share count by a similar number. So that can really hurt your equity returns in the long run. So, I mean, I'm not really taking a position. It's kind of unclear whether they'll need to raise equity here or whether they can ride it out. But that's your risk.
So we're getting some points in Ben's playbook to ride this out. I think number one is you don't know where the news will go, and so stay invested. Number two is look at a balance sheet and avoid companies that will have to raise equity or could get in trouble with their debt load. So we'll keep building this list as we go.
Yep.
But I guess let's turn to the opportunities as you're seeing them. So you said you were deploying money in April. Where do you want to go? What were the opportunities that were interesting you?
We mentioned gold as a bit of a shining light in the market and potentially as a funding source. The other funding source we've used is rotating out of some of these takeover targets. So PointsBet, we've been talking a bit about, which has been flat in a down market because they've got kind of a locked-in takeover bid at $1.06 or whatever it was. We have had a bit of cash, as we mentioned, and a couple of things that we can kind of lighten a bit in terms of in the gold sector or otherwise. And the opportunities, I think in the current market, growth stocks are starting to look good as well. And that's not the growth at any price stocks like Pro Medicus and Pinnacle and others that have kind of been fundy favourites for a while, inflated to far beyond fair value in our view, but have good growth. So we're looking at kind of more under the radar growth players, like we've mentioned Catapult on the show before, Energy One also in the tech space, RPM Global also in the software space. So that's one area, kind of oversold growth and oversold tech. Another area which we've just been buying recently, which you boys might enjoy, is biotech stocks.
Okay.
And that's not an area that we actually do basically anything in usually. We don't take on clinical trial risk. We've seen a massive blow up in Opthea, OPT, which basically looks like it's going to be a zero on failed phase 3 trials. So we're not in the business of taking, a gamble on FDA approval. But what we can do is look at some companies that have gotten through the approval pipeline and are selling products and either profitable or about to be profitable. So I'll raise two ones here. Botanics, BOT. Now, this has a bit of a checkered past and checkered reputation, which kind of creates the opportunity. I think a few years ago, it was some medical cannabis wannabe story and got washed out in that space. But a couple of years ago, new management have come in. They've brought in a product which is near its final stage of approvals. Since then, they've got it approved, and it's called Sofdra. It's a product for it's hyperhidrosis, which is excessive underarm sweating.
Okay.
So I've become an overnight expert.
They say invest in what you know.
Wow.
But it's a really interesting one because if you think about what people want to spend money on health-wise, Ozempic, anything physical appearance related. And I've seen some instances where, excessive sweating can be a real big factor for people. Yeah, the key with this one is that management have done similar things before in the dermatology space, and they've sold businesses for multi-billions of dollars. They've got this real nice system in place where it's all telehealth. It's largely insurance reimbursed, and they've got 25, 30 sales staff that have basically followed them from company to company and are the kind of the gurus in the space. And there's an analog in Japan, which is slightly smaller than the US market, but has had great uptake. And if we see a proportionate kind of equivalent uptake in sales in the US, where bot is focused, we think this could be multiples undervalued. So it's always tough to say at the start of the biotech journey, like how much they're going to sell. But I think with a product like this, with an easy path to market, you're kind of a bit more de-risked. And the management team, it's one of the most heavily invested management teams I've seen in the small cap space, period. All the directors, not even just kind of one founder. So they're all kind of pulling in the same direction. So that's one. I'll quickly mention Neuron, NEU, which we've never owned until now. They've got an existing drug which is selling and profitable. They've got a theme which I like, a boatload of cash on the balance sheet. They're doing aggressive buybacks. They're buying back $1 million of stock every day now. And they've got another drug in phase 3 trials, which I know I said we don't take phase 3 risk, but we think the existing drug is probably worth $15, $16 a share. Neuron's trading at $9 or $10 a share just because it's been whipsawing around.
What does the drug do?
It is for Rett syndrome. So it's kind of like a rare drug in that sense. There's not a huge addressable market. So it's kind of like opposite ends of the spectrum. Bot is kind of like a large addressable market to the consumer. Neuron is kind of targeting a lot smaller market, but higher value. So they get these things called like rare drug designations where the FDA supports them and they can basically sell their product for nosebleed sales prices. And it's covered because you've got to incentivize companies to go after the rare stuff as well as the low-hanging fruit stuff. So yeah, a couple quick ones that we think are kind of getting interesting. Not a huge part of the portfolio, I will caveat with that, but it's been really discarded by the market, and these companies are, underpinned by existing profitability essentially.
I've got to ask, given the content we've been doing with Luke and the 500 to 5,000 over the last few weeks, Antifa Minerals has been right up there.
I was hoping you might ask about that.
Where's you thinking at with that? And then I'll tell you what I've done with it.
What have you done with it? I wasn't consulted on this decision. Luke said advised you wisely.
He's not going to love it.
So we're still pretty bullish on Antifa.
Yeah.
I mean, the catalyst is now pretty near term for that one. Greatland Gold.
Which was the listing, right?
Yeah, the ASX listing here. Listeners will know the story, but it's basically they're running out of mine life at Telfer. They've got another asset that's not coming on for a few years. To provide a prospectus to ASX investors and to get fund managers confident that, this will be a robust investment and it's got a mine plan that's underpinned for a long-term mine life, they need to plug that gap. And now Greatland's going around telling everyone that their exploration upside at Telfer and there's blah, blah, blah. And this thing's been mined for 30 or 40 years, continuously at high rates, and Newmont sold it for cents on the dollar. So right. I think the read-through is, even if there's a bit there, there's not going to be, millions of ounces of ore that they're suddenly just going to stumble across overnight. So Antifa, it's still one of our biggest positions in the small cap fund. And maybe for your 10x challenge, you've gotten a nervous trigger finger on it. We're not in the business of doing 10x high specky stuff. We just want to get
it's very hard.
It is very hard.
So what have you done with it?
So at the time of the recording, so about a week ago, towards the start of the month, I halved it and then put it into a short NASDAQ, which Luke had told me.
Short NASDAQ?
Yeah, leverage?
Yeah, leverage.
Yeah, nice.
Yeah.
Michael Burry in the studio.
Did you get out at the right time?
No. Well, so it's an ASX listed short NASDAQ, and so at time of recording, it's got a stop loss on it, but I'm going to obviously see in 25 minutes what's going to happen to it.
Is that 2 times leverage, is it?
It's 2 times. Yeah, well, it's up to 275, but it's currently at about 210, I think, yeah. So it's been doing well.
For people who are confused, percent, you mean?
Percentage, yeah. So that's been doing well, but it could all come crumbling today. But yeah, I think I've still got a bit of Antifa sitting there. So it'll be interesting to see what happens with that. All small caps today, I think. It's going to be interesting.
Could have a good bounce.
Yeah.
So I've been making some more notes. So we had stay invested, looking for companies with a boatload of cash on the balance sheet. Avoid fundy favourites that are bid up to crazy levels. One thing that you've said a couple of times, management teams that have done it before. You've said that around AIC Mines, and you also said that around Botanics. For people who are, don't have the opportunity to speak to management teams like you guys do, but are assessing management teams from behind a computer, seeing their track record is something that anyone can look at before. So what do you want to see? Do you want to see that they've successfully, created shareholder value in a listed company? Do you want to see that they've been an executive at companies? What for you is starting to get some ticks against management teams?
It really depends on the type of company. So AIC, that's really a copper production growth story and maybe a bit of regional consolidation, which is pretty much exactly what Aaron's done at Evolution in terms of rolling up some sort of mid-tier assets at the right point in the cycle, bolting them on, integrating them, and bringing on a good team of people that can actually deliver. Bot, I mentioned, it's really about they'll take late-stage assets and monetize them. So they're really the sales funnel, and they've sold businesses for many billions of dollars US. Bot is under $1 billion Aussie. So it's kind of like if they get good traction, they can either bolt on another product into that platform or, in an ideal world, sell the company for a premium to any of these large pharma companies that kind of does the roll-up M&A stuff. So it's really a case-by-case basis. I've got another very micro-cap company that I could give as a management example.
Yeah, please.
We've recently been buying it, and it's a high-conviction position. I'm going to say it's an explosive opportunity.
Here we go.
Because it actually operates in the explosives space.
Okay.
So mining explosives.
Not Orica. No, that's so big, yeah.
So you've got Orica, you've got Incitec Pivot, IPL, which is just renamed to something else. I can't remember off the top of my head.
Oh, it's like something Nobel, isn't it? Yeah.
Dynamic or Nobel or something, yeah. So you got those two big guys, and these guys have, it's called Aquarian is the company that we've been buying. AQN is the code. 30 mil market cap, and it's illiquid. So we were actually looking at buying it, and they've just raised some capital, $5 million I think they raised, and we kind of cornerstoned that. So for full disclosure, we're obviously invested. But the reason we like it is they've acquired this Woburn facility off a Japanese group that was basically from a corporate level getting out of Australia. So they sold these 3 plants. 2 of them went to the Oricas of the world, and then 1 went to these guys. And the reason why these guys picked it up is because the management team came out of that Japanese group and was like believed in the underlying business and wanted to do their own thing. So yeah, it's a founder-led business again, but it's the team underneath them. They've all done it together. They own a lot of the stock, so it's not like it's super liquid, even at the best of times at that scale. But the reason we like it so much is they've got this facility, which is probably replacement value worth $20 million, kind of underpins the value and critically underpins your downside. We think they got a great deal buying this asset. For those that aren't familiar, drill and blast when it comes to mining, like the Pilbara, I think Pilbara iron ore, to move those tons, it's a drill and blast setup. You put your explosives in, it kind of unsettles the dirt and makes it easier to truck out of there. So iron ore is the main one. They've also gold mines as well, which obviously at the moment, given how strong the gold price has been, there's a lot of work in that space. Like we've mentioned companies like Imdex before, kind of exposed to that gold capex cycle. These guys are kind of another play on that. But I've kind of gone into the weeds, and the reason we like the tailwinds behind this particular area of explosives, so Aquarian does emulsion explosives, which works really well in wet environments. Now, Pilbara iron ore, it's all going below the water table, which means you can't use the Orica explosives because they just don't work as well in wet environments. Whereas these emulsion explosives, it's kind of their specialty. So I think it's something like 50% of iron ore in the Pilbara is expected to be below the water table by 2030. So it's starting to be a real significant chunk of production, just as all the easy tons get mined out and you're left going a little bit deeper. So that's the first tailwind which they've got. Second one is just gold and proximity to those gold mines. And we think that's a space where there might be multiple winners. And Aquarian, basically they're getting priced on the current utilisation, which is low because they've just acquired the facility. They've signed one big contract and the stock spiked like 30 or 40% in a day. But we think there's a key contracting period in the next 2 to 3 months, which we've seen what happens before if they announce a contract. And if they can get this to fully permitted production capacity, then this stock could be 3 to 5x on my numbers.
Careful, you say that, Bryce might start buying it for his challenge.
Well, you've been dumping our other stocks.
No, I'll be back in, don't worry. With a company like this, is this something that comes up on sort of screens that you run, or is it just because you're so into this sort of, industry generally, and it's through reading that you're doing on other companies and it pops up? Like, how do you find a 25 million market cap?
When I get in the morning, it's the office, I'll usually screen all the announcements from the get-go. and anything that pops up that's interesting, like there's obviously a lot of dross in there.
When you say screen all the announcements, like that would be a lot of announcements, I imagine.
There is a lot, but I mean, most of them are just like application for quotation of securities, which means they're issuing new shares like confetti. But
announcements across the whole market or within your
across the whole market.
Yeah.
But a lot of them are flagged price sensitive.
Yeah.
So like by the time you narrow it down, there might be like 5 or 10 interesting announcements that I'll quickly skim through. And I saw that Aquarian won a contract. So that was kind of how it popped up on my radar. Only one broker covers it. Just kind of coincidentally, actually, I spoke to him around that time. And then Luke has a contact in that industry. So we flicked across some notes to him, thought, what do you think of this, mate? Got some feedback from him. And then I kind of did some more work on it. So I suppose that's a good example of one where, it's tiny. I vaguely remember it IPOing a couple of years ago, but like haven't really checked in on it since. Yeah, you kind of check back in, price might have moved, but there's lots of new info. So you kind of reassess it from scratch. So
nice.
Well, we're pulling out some points throughout that conversation. Stay invested, look for companies with a boatload of cash, management teams that have done it before, avoid fundy favourites that are bid up to crazy levels. Any other insights you want to leave us with as we're looking for opportunities in this market environment? Yeah,
I think you can't time the bottom and have a strategy in place. Like it's all very well and good for me to prattle on about small companies that I've done hours of work on. But like for the average investor out there, there's no real point kind of going out there and looking to buy these kind of companies yourself, I believe. So I think it's about sharpening your pencils, having a watch list of, if you're doing direct companies that you think are high quality, that you buy at the right price, making sure you've done the work leading into the downturn, because I feel like this is the kind of the golden opportunity you might get once a year, once every few years even, that you can really generate a lot of outperformance, and that, some fund managers have dined on 1 year of outperformance for their whole careers. So hopefully I'll be saying the same.
Yeah, that 33% year you guys did.
Yeah. I've done 33% last year.
I think that's a really important point, is do the work before the downturn.
Exactly.
Yeah.
Exactly.
Scrambling.
Yeah, because like, some of these companies, and it's not just about looking at the announcement on the day. Like often I've been following it for years, and Luke will tell me, nah, you can't buy it. It's no catalyst, or too expensive, or it's everyone else owns it. Like, who's the incremental buyer? Like, there's all these, wisdoms that he's dropping to me, which are, they're true. Like often I'll find a really cheap stock, no catalyst, no one's actually going to buy it. And I've owned these PA in the past, and they just sit there doing nothing and eventually sell them at a loss. So he's right. But when we're down 10%, then we can both be like, bang, we know what we're doing. Let's
go. Love it. Well, Ben, we should also say that you and Luke have a research report that comes out twice a month, where you send a stock recommendation in each report. It's called Good Research. So 2 stocks a month. I think it includes business fundamentals, valuation, your trading strategy. A lot of the stocks that are in the portfolio come out through there, and I think a lot of that are on the watch list. So if you want to subscribe to that, it's exclusive, it's limited. I think there's only a handful of subscriptions left. You can head to goodresearch.com.au and use the code MATES at checkout for 10% off. Get on that. There's been some pretty good recommendations in there. Antipa was one of them, I must say, so have used that myself.
Yep. That's a no-brainer if you're a self-directed investor in your
assets. Yes.
2 years every month. That's it. I mean, I'm surprised we're giving it away for so cheap. I think we should be ratcheting the prices on this. Check it out.
Make sure you go to goodresearch.com.au, use the code MATES before Ben gets his way and jacks the price up. Yep. But Ben, thanks for jumping in today and telling us how you're approaching this moment.
A lot of fun. Thanks, Bryce. Thanks, Rim.
Thanks, Ben.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.